Hello and welcome to Trading the Trend. The question we ask every week at this time is, what trends are you riding? Normally we'll talk about bullish and bearish types of trends. Today we might talk about some neutral type of trends and strategies. We have Brent Moore's in the chat and we welcome all of you here as well. So just quick heads up, if you ask a question, you see a response with the initials BM, that is Brent Moore's, a fellow instructor. So he's going to be the co-pilot here today. So just real quick as we get started, remember, we talk about in this class stocks and options, okay? So we'll have a little balance of that. Some of you don't trade options, but we'll talk about stocks and then vice versa. So real quick, remember that options carry a high level of risk, not suitable for all investors. There's a pamphlet called The Characteristics and Risk of Standardized Options. Make sure you have that and are aware of that. Also remember the information here is provided for general informational purposes only. This webcast discusses technical analysis. There's other approaches like fundamental analysis. We're getting into a lot of earnings where that fundamental analysis now becomes important and how those fundamentals of metrics affect stock price and or technical analysis. That absolutely does play a part into it, okay? It's not all about candlesticks. It's about, did they make any money, okay? And what is that forecast going forward? Also remember that when we talk about our examples, paper money, software application will be the application we'll be using. That's known as the desktop version. Investing involves risk, including loss of principal. Also remember when we talk about investing, it does have risk, absolutely. But think about what are some of the other risks of maybe not investing, okay? And so that's kind of also a risk as well, okay? So risk all around us. Now, remember when we talk about examples, short options, what are those risks with that? Known as assignment risk, we'll talk about that. And option Greeks measuring a sensitivity to something like direction, change in delta, time, and volatility. Now, we'll actually hop right in. We'll talk about just briefly where the indexes and sectors are. There's been a theme that we've had this week talking about exits, okay? We've talked about stops, stop adjustments, and we've kind of thrown out there maybe even using derivatives as a way to hedge over maybe some pullbacks and or over earnings. I'd like to kind of further that here today as we talk about some of our examples. Now, when we bring up examples, we'll talk about past examples we've done and new examples. So let's go ahead and hop right in. Now, remember, this is not a just kind of a one-way discussion. We're going to kind of have a little two-way discussion. So first off, if we pull up, let's say, just real quick, the Dow Jones, that's the one that I saw kind of went down quite a bit. We had IBM, okay, that did not help the Dow here today. Dow down 178, was down even worse than that. And if you look at, let's say, the stocks in the Dow, those stocks, IBM down 15 points. I'm right there. It's down almost 7%, okay? And if you pull that up, you're going to see that there's a big gap in the chart to the downside. Boo! Okay, now, paper money account did not have that, so it doesn't matter. But that's not helping the Dow. The other one that's not helping the Dow here is you're going to see that Honeywell also gapped down on the Dow, okay? And John made a comment in the chat. Hey, I moved up my stops. I got stopped out of 4 of them. I believe he said prior to the earnings. And the one thing is, and he said that kind of that's what was meant to happen, but overall, we got to kind of understand that sometimes they don't always gap up. Sometimes they can gap down, and there can be a hole in the chart. Well, what's the risk there? Well, if you had a stop, that stop could have triggered or could have got filled lower than where the stop was, okay? Now, if you took Tesla, it could have went the opposite direction. So you got to understand there's good and bad examples here. Boeing, the union actually, after being offered a 38% raise over 4 years, they said, nah, we want more than that. And that was even not just a 38% raise over 4 years, along with 401k benefits / pension benefits and so on. They rejected it, okay? Now, I got to ask you the question. In your job, do you get 38% over 4 years? I'm just asking a question, okay? So it's just kind of interesting what's happening at Boeing. And that has been something that has been weighing on the markets for quite some time, okay? If you look at Boeing, well, it's grounded. Okay, let's just say that. Okay, I've been waiting to say that all morning. Now, when we take a look at, let's say, the NASDAQ, very neutral. Now, on Tuesday, we talked about the index being an iron condor example. We'll show that where it stands, wholly sideways. Now, remember, we've been talking about we're going into not only earnings, but going into the election, okay? And we're talking about, what, 12 days, okay? And someone made the comment yesterday in the chat that the election is like a national earnings day. I think fine. I think you could say that. And with that national earnings day or / election coming up, the VIX has been staying a little bit more elevated. I want you to notice that the volatility or VIX level trying to get across to the upside. Now, what does that probably mean for stocks on a majority basis? Well, if we start to see, let's say, the moving averages cross like they did here, if the VIX goes up, that probably means stocks go down. Now, what type of strategies would we probably see in that scenario? Well, we'd probably see exits, stops being triggered, maybe protection being entered, and so on, okay? So when the volatility goes up, you're thinking more about playing defense, okay? Protecting capital. When the volatility is going down, you're thinking more about offense. I'm going to buy something, okay? So keep an eye on this. If that volatility actually at VIX level does cross over to the upside, you're playing kind of more into the theme of what we've been talking about all week, okay? Now, if I pull up just real quick, Russell, what did it do? It did go down near the bottom of the channel, no change from yesterday afternoon. And if you look at, let's say, just the SPX, there it is. Now, the one thing what you're going to notice is not a massive material pullback so far, but we are kind of in where we have the moving averages red here, okay? So when we look at sectors, the only sector that got a little push here today was discretionaries, and you could pretty much think one company called Tesla that pumped 43 points to the upside in the tune of 20% in one day. Okay, now this is why some people like to hang it out over earnings, because they're thinking, man, if I could get one of these in the month, that would be the month. But what about the other ones? Okay, so now I want to kind of start with this. Okay, now do you think investors just put it all in one morning and said, man, we ain't got no more capital? Do you think they got in just for the morning? Probably not, right? So the biggest thing what I want to kind of do is start here is I want to kind of start with kind of going over just briefly, just kind of talk about strategy for a sec. So remember, in the terms of investing, we know that if we buy, let's say, stock, that's the most capital intensive, I'll put a dollar amount, and for example, it has the highest delta, D with an up arrow. It's the highest delta. Now, usually if you're in that situation, you want V, volatility, to be declining. Well, that's not what we're seeing in a lot of positions. We're seeing actually volatility increasing. So for example, if we said, what has a delta of 0? Anyone tell me what that is? What has a delta of 0? I'm not trying to trick you here, okay? What has a delta of 0? Cash. Cash is a position, okay? Now you're going to see where these paid money accounts are. I'm just talking about the cash position. So I'm just going to state where the balance is and the cash level. If someone else wants to track it, fine. I won't be speaking to it, okay? But I want to kind of show the cash and why is the cash where it is, okay? So any strategies, for example, above this point, let's say short put vertical, long call vertical, okay? If someone actually thinks the market is going to be more volatile, and let's say this paper money count does, well, probably going to be doing less stock on a majority basis and probably going to be doing some more examples of short puts or cash secured puts, CSP, okay? So over the next 2 weeks, we're probably going to be thinking about short put verticals, cash, long call verticals, cash secured puts. I am also going to include collars here, okay? Now, we had a question yesterday. Is a collar a bullish position? Oh, okay, let's talk about that. So over the next 2 weeks or so, Probably not going to be doing many long calls, probably not as many covered calls, probably not as many long synthetics. Now, that doesn't mean that there's none, but I'm just saying on a majority basis, probably that's going to be a minority. The majority of our examples are going to be over here on the left-hand side where we're expecting the volatility to be a little higher. Okay, now, if we actually go in to take a look at these, this paper money account and say, well, what is the cash position? Cash has a delta of 0. The cash is at 177 of the balance of 252. So this portfolio is only really trading $75,000. That's it. $177,000 is just sitting there in cash. Okay. Now the margin account sitting at 56-ish, and it has the balance of 69,000, almost 70. So it's only really trading about $14,000. So why is there so much cash? Well, if you get stomped out, that cash goes back to the account. Okay. And if you don't replace it, well, you're sitting in a position called cash, and it has a delta of 0. Now, the biggest thing is why would an investor do that? Well, if you're going into a whole bunch of earnings, if you're going into election and you say, I don't want that directional risk or risk among other things, the investor might say, I'm going to allow myself to get stomped out, sit on the cash for a little bit, and wait it through the earnings and the election. Guys and gals, that's a strategy, okay? When you feel like there's maybe some fogginess out there, the investor is trying to protect their capital. Okay, now, first thing I want to do is I want to go back to Tesla. And remember we talked about it. If we're going to do those strategies we talked about on the left-hand side, we're kind of thinking maybe the market might be more volatile, okay? Now, if we take a look at this, we're going to use a short put vertical. Now, if you take a look at, let's say, what happened to the volatility today, what do you see that happened with the volatility today? Well, the volatility going in today was about 63. It's now down to 58. Okay, now that volatility is not that low. It's still at 58. Now, if we go back into the trade tab, we go back down to Tesla. We're not going to look at these ones that expire tomorrow. We're going to look at the earliest, the 22nd, 15th of November with 22 days left, or go down to, let's say, 57. Now, if we're doing a vertical, the time decay is not, typically 57 days away. It's going to be in the ones that have 20 or so days left. So we're going to focus on the 15th November. Now, the good thing is faster time decay. The bad thing is less time. Okay? Now, here's what we're going to do. We're going to go down and sell the 245. Now, remember, you can think too, okay, do I want to kind of pick a strike based on delta? Do I want to pick a strike based on where I think the stock could stay above and or support? If we're just going to use delta, okay, as a kind of an example, why are we not picking this one? Well, it's only 21 contracts in the whole entire world, 43 contracts in the whole entire world, okay? So we're going to pick selling the 245, and then what you're going to now see is we're going to pick the 240 below. Now, I'm going to tell you what I've seen. Investors, they tend to have I like to do this. What you like to do sometimes is not maybe the right thing to do. Sometimes you might like to buy long calls all the time, but if the direction of the market is not that strong, that might be a maybe not great strategy, okay? There's conditions for different types of strategies. And if we're kind of below the moving averages, which we are, picking a long call or a long synthetic or a long stock, that might be more of a shorter term risky type strategy, okay? Now, we're going to pick a short put vertical, okay? We'll look at this in terms of both the IRA and the margin. Now, if we said in the paper money account, the margin we could risk $700, well, we'd probably be doing 2 contracts. So if I went to where it says single account, multiple accounts, the margin account, we're going to go 2 contracts, okay? Now, the buying power effect, really think of that as the maximum loss. The IRA, okay? We're going to go down to, let's say on that IRA, we could risk, let's say $1,500. We'll be doing 4 contracts. Okay. Now that's what we show. Okay. We've talked about that historically. 6 total contracts. That 6 total contracts now is affected by the max. It's that maximum profit potential is now over 6 contracts. This potential maximum loss given the vertical is for the 6 contracts total. Okay. And that's going to show us the break even right there. Okay. Now what we're going to do is send that order. Now remember, we've talked about, we said on Tuesday, what is the goal of this? Well, if we could get 50% in 10 days, that's like 80%. The investor might take the profits. If we can have 65% profit with greater than 20 days left to expiration, that's like 80% at expiration. And if we can get 80% ever, the investor might say, done. Okay? Exit or roll the position if they think that trend's going to continue. So first trade that we're doing here is Tesla on the earnings pop. Now, notice when I put this order in, at the very top it says total all accounts. Where's my position? Well, we got to select what account you're looking at. There it is in the margin right there. And if I go to, let's say, the IRA, it is right there. Okay. Now, Luke is trying to get underneath my skin, but I'm not going to fall for it, Luke, because I know you're joking with me. Okay. Luke says, it's too high. Okay. Oh, okay. Now, I've gone, I'm going to joke with you. I've gone to counseling for not being agitated. I'm joking. Okay. So here's the thing. Remember, it being at a high is proof of an uptrend. Number one, if you, for example, make a high, the highest probability is it for to make a higher low. Now, is that 100%? No. Example given, Netflix. Okay, so let's go to Netflix for just a moment. Okay, so just the other day, we saw Netflix make a brand new high. Okay, made a brand new high. And so step one, we made a new high. The highest likelihood doesn't mean 100%, is for it to make a higher low. Now, you'd love that higher low to be right at maybe the moving average and bounce to the upside. Now, a lot of times that can happen. That doesn't always happen, because if you look at Russell, you'll see that it wasn't quite a short-term higher high. Well, in the short term it was. It wasn't the highest high, but if you go back, it's kind of sunk back to where these prior levels was. Now, it could still make a higher low, but if you go lower than 2178, it's like an equal low, okay? So sometimes it's the higher lows. When you look at Russell compared to Netflix, well, you look at Netflix and it just kind of looks like it hasn't had to drop as much before you get buyers to come in. That is showing Netflix showing really more of an example of stronger momentum, okay? Then it's when it dropped, it didn't have to drop as many days, and it's also it's holding the moving averages and the breakout point where the Russell did not. So trade number one was Tesla. Now, I want to go back to kind of like the numbskull trade of the week. Okay, I'm just joking. Okay, now, sometimes it doesn't always work out. Now, there's a stock called T-Mobile. Okay. And we did the example of selling the stock prior to earnings. Okay. But don't feel bad for the paper money account. Okay. It wasn't all bad. But sometimes you can get just an adverse react. You can kind of get something where, hey, it pulled back over earnings. We didn't know what the earnings was going to be. Stock doink to the upside. Now, what was that last trade? Okay, on that, just so we don't feel as bad in the paper money account. Well, bought it at 207, sold it at 222 and change, $15, 100 shares, $1,500. Okay, now that another 11 would have felt a lot. It actually would have been $10 higher than what we sold it. Would have been 1,000. Okay, in the paper money account. Now I want to kind of go back to this. Okay. Now, the one thing is we don't know is, number one, what is the earnings going to be? Number two is, we don't know which institutional investors might be waiting to buy, or sell. If someone is going to buy huge quantities or sell huge quantities, typically the best days to do that is on the earnings when the average volume is typically substantially higher. Now, what we're going to do with this, if we go back to, let's say, that 3-year weekly chart, this is that mother of a trend, okay? And remember what we said is if we get the moving averages to go green, really what the investor is trying to do is trying to ride that trend, okay? Now, if we take a look at this, as we go back to the 1-year daily, we might say it's too high. Well, you could have said that 20 other times in the last month or two. What we're going to do is we're going to set a buy limit, and we talk about the middle of the candle all the time. If we set it down about a third, we're going to try to buy it on a little fluctuation. Now, if we did this, what we're going to do is we're going to right-click on the chart. Now, if I buy on and sell on the chart, this is a stock trade, okay? We're going to right-click on that, right about a third. Now, why not take it halfway down? Who says it's going to go halfway down, okay? We're going to go buy custom. We're going to go with stop. Now, that buy order is a limit order, okay? So if you were at your limit, that usually means you ain't going no more. Okay, data GTC. So that's saying do not buy those shares unless you get to that price or lower. Okay, now number 2, on the stop. If we took out today's open price, that probably wouldn't be a great sign. That means it's giving back all of that pop, okay, to the upside. And that would be a deflating type of price move if you're a bullish investor. Today's open price was right around 222.99. And if we take 222.99 less 2%, survey says 218.53. Now, I cannot stress this. A lot of times people think, well, I don't need to do position sizing anymore. I have experience. That could not be the farthest thing from the truth. One of the most damaging things about the stock market is that the investor deviates away from what they know. And some of the most damage you can do in the stock market is, breaking your own rule set, okay? So if I took, let me just kind of look at these numbers. There it is. So if we're going to trade this, let's say in the margin account, let's say the balance was 69,250, risking about 0.5%, no more than anyone in the trade being 10% of the capital, we're going to be about 30 shares of stock, okay? Where do we put that in? Well, first thing we're going to do is we're going to go to where it says single account, multiple accounts. We're going to try to pick up 30 shares in the margin, okay? 30 shares. Now, James, wait. What about the IRA? Well, let's change it. 252,000, maybe about 250 as well. Most we could put in, if we kind of use a 10% capital threshold, 25,000. Well, in this one, whatever is smaller, the position sized, we bought 112 shares, it would be above 25,000. Can't do that. So if we did 109 shares, it would be 25,000. Now, if it's going to be 109, we ain't going to do 109. We're going to just round down to 100. Why? Well, because if we want to do things like a covered call, etc., we don't want we want kind of like 100 shares, 200 shares, etc. If we could get closer to 200, we go up to 200. If it's closer to 100, we're going to go down to 100, okay? So we're not doing 109 in the IRA, just 100, okay? Now you're going to see that these shares total represents 130. Then remember what the stop is telling us. That's the trigger to sell. It doesn't mean that's what the fill is going to be. You would like to sell at 218.53, but that doesn't mean that's where the order gets filled. That's an unknown, a risk, okay? We're going to send the order. Now what you're going to see is we could put an order right there saying, hey, we know if it goes up, the issue is it could pull back some. And we're trying to catch the price and maybe giving about a quarter back of this massive, okay, massive, what do they call it? A massive candle here that looks like the Eiffel Tower. Okay. Now, James, be honest. If the stock went up $10 like that, is that frustrating? You're human. Of course it is. You're thinking, my gosh, I could have had the 10 points higher. But that's kind of looking myopically, because if you did this over 5 and you had IBM and it gapped down, well, it doesn't always work. In this case, T-Mobile, okay, did pop to the upside. Now, if we take a look at this, any questions you have? So trade number 2 is T-Mobile, okay? Now, I want to go back to just real quick an example of, in this case, I want to bring up Chevron, okay? So one of the strategies, okay, and I want to bring up this stock right here, Chevron. 100 shares of stock, that's where it was purchased, and we see that the mark level is right there, okay? So we're down on this position. Now, why do we bring this up? So you got to think back to a comment that we made last week, okay? There's risk if you get in, out, in, out, in, out, a lot of times on multiple different positions. When you add up all the risks that you took over the year, it is probably a heck of a lot more than you thought it was. Some investors might not like that, okay? And so what some investors do is they say, look, James, if I have 100 shares of stock and the trend is very neutral and there is upcoming earnings, and they say, look, I don't want to have a potential undefined risk until zero by holding the shares of stock. So what could they do? Well, we know that if you have 100 shares of stock and you would consider capping out the upside for the short term, okay, till expiration, we know that we could do a cover call. We could just sell a call. You hope that it could be higher than what you bought the stock for, okay? Now, but that doesn't address the downside. Well, we know if we sold the call, you could take that credit to help pay for some, maybe all of, the put. And that's really tends to be what you're more concerned about, the downside risk, okay? So what we're going to do is going to go to the trade tab, Chevron, okay? Now, what we're going to do is you can pick how far do you want to go out in this case. Now, notice we like to start with stocks that trade over 1 million shares on average. So one of the prerequisites is if it doesn't trade 1 million shares on average, we're not going to show the example on the paper money portfolio. Why is that of importance? Well, because if we go in a situation where the market isn't trending very well and we want to protect some of these individual positions, we want to know that they are defendable using like cover calls and or bought puts. If we do the combination of those two, that's a caller. Okay. Now, what we're going to do is we're going to say, look, I will sell you those shares at 152.5. Now, wait, why did you pick that one? Well, it's out of the money. When we talk about going out of the money, we typically are talking about something where it has a delta of 30 to 40. Well, this is the closest thing we can get to a delta of 40. And that is also a strike. That strike 152.5 is higher than what we bought the stock for. They're going to give us approximately, if we do it right now, potentially, need to see what the fill is, about 305. Okay, maybe a little higher, 310. Now, we're going to use that put, and I always say this, okay? Why doesn't the investor buy a put? They don't want to pay for it. When you're losing, the thing that you typically don't do is say, man, I'm down 178. What I want to do on top of this is to do a trade where I'm going to outlay more capital in which I could lose, okay, on top of that. Most people aren't going to do that, okay? Now, what I'm going to do is, so if you own the shares already, how do you do this? Pretty simple. Right click on the option that you want to sell on the call side. Sell vertical. Okay. Now, when we do this, I want to kind of understand this because we've had a question on this. Okay. So your delta right now is 100. Think about that scale. Okay. You're all the way out here, delta of 100. The interesting thing about options is you can change the sensitivity on the position. Well, if you sell a call, you sell it, it's negative delta. Now wait, if you have the shares, we do, and you sell a call 42 delta, where is it going to put you on the scale? 100 minus 42? It's going to put you right here about 58. Okay? So if you go farther to the left, are you becoming more sensitive to direction or less sensitive? Less sensitive. Why would you want to be less sensitive to direction? Well, maybe the trend is neutral. Maybe the trend is down. Now, if you come over here and say, look, James, I'm going to buy this put with a negative 37 delta, well, if you add that up and kind of add them all up together, you're going to get a delta of 21. Okay, so let's think about this. Why would you want a lower delta? You are not as confident on the direction of the trend. It's not trending to the upside. We're not making higher highs and higher lows. So why not just sell the stock? Well, the reason to own the stock is not just direction. The investor might say, James, I want something that has a long track record, like a Chevron. Maybe that stock, for example, has a big exposure to the sector. The third reason is maybe the investor says, James, I do Chevron because I like it for the dividends. But that doesn't always mean the stock's going to trend, okay? So that's why sometimes people will use collars as a way to protect the capital of the stock, but also they don't want the directional risk. Now, we know that when the investor sells the call, someone can take those shares at any time, irregardless of if we're at expiration. But they have to give us 152.5, and they have to beep, beep, bring all that premium, irregardless if we're all the way at the expiration. So if they take our shares, the call goes away and the shares go away. But what's left? The long put. Why did they not take that? Because it's not theirs. If the investor buys it, it's theirs until expiration. Okay? Now, what we're going to do in this case is we're going to protect. We don't know what's going to happen on earnings. Okay? And what we're going to do is we're going to try to do this. Now, is it for credit or debit? Well, in this case, we get a credit of 90 cents or $90. But is that true? Well, it's not true because we didn't put in the 147. Okay? So if we collect this, let's verify this. If we get the 152.5, that is right. And if we look at the put side, what you're going to see in this case is, okay, the 147. That's actually weird. It went to a vertical. Sell, okay, collar. That's why that number looked a little weird, okay? So we got the 152.5. That's fine. The 147, now notice it's buying that put plus one, and it's giving us a plus 48-cent credit, okay? Confirm and send. Now, I'm going to show you something. If you take a look at this position, we're capped at the 152.5, but get 48 cents on top of that. That's pre-commission. Since we're selling a call and buying a put, the commission is $1.30. I'm going to tell you this right now. There's a lot of people who know about collars, but if you really ask them, do you really do them? I think probably a large majority would say, no, I don't. I know about them. I don't do them. Collars are an interesting strategy for a stock investor who wants to try to ride that trend long term, but doesn't want to get out every time the moving averages turn red, or when there's a bad market posture, or when there's maybe earnings. So collars is an interesting trade, but the risk of it is you cap yourself out in the short term. Okay? Now, are there any questions with that? Okay? So this, now, by the way, has the trade filled yet? It hasn't filled. What I want to do is I want to come in here and I'm going to change this to where the mid price is 44 cents. We moved it down 4 cents. And what I want you to watch, and I'm going to tell you right now, and I'm not being mean, okay? Most people don't really understand what the delta is telling us. That delta, if it says 100, is the directional sensitivity, profit or loss, unrealized profit or loss, if the stock goes up $1 or down $1, theoretically. So if you have a higher delta, you're really more confident in that direction. If that delta is lower, you're not as confident, and you're probably more banking on time or volatility, okay? Now, it still hasn't filled. I want to make sure this fills. So I'm going to change this to market order, which I'd expect we're not going to get as much of a credit. And remember we said the delta is 21? There it is. Why is it 21? Well, when you own the shares and you overlay the options on top, in aggregate, the delta is 21. So now let's say the stock gaps down $10 on earnings. Well, in our minds, we would be thinking, well, take a delta of 21, times it by $10 stock move, but to the downside, we'd be thinking the position would be down about $210. I'm going to tell you this right now. The stock market is not just only forecasting upside movement. Sometimes you've got to be thinking about how do I play defense to protect my position. Now, does that mean that everyone should trade options? Absolutely not. But this is why some investors consider some type of options, because they want to use options as a way to protect. The advantage of this position is you're using the credit from the call to help pay for the put. And so now the con about that is you cap yourself out in the short term on the stock. Okay. Now, any questions there? Now, KN says, can you talk about when to use callers on the stock SPX? Okay, just so in general, okay? So when does the investor consider using callers? Right into the teeth of earnings. If you're 4 to 10 days probably to earnings, you're probably thinking about considering some callers. Number 2, when the VIX starts to go up, like it is now, okay? So if you start to see the VIX starting to cross up like that, you're probably thinking, you know what, if I have 100 shares, you might be thinking, you know what, I might be kind of thinking about starting to use some collars. So when you see the moving averages do something like that, or cross, or the moving averages do something like that, and or cross, and or do something like this, and or cross, you're probably thinking, you know what, if I have 100 shares, I'm probably seeing my stocks go flat, or probably starting to pull back. Number 2, if we go back to the monitor page, and if we start to see, for example, some stocks where the trend is 5, 5, 5, 5, 5, that is telling us, hello, that our stocks are starting to fall down below the short-term moving averages. What's the big deal? Do you understand? The way that someone made the unrealized profits was the stock was above the shorter term moving average. I don't think people understand that. Let me repeat this. Go back. The way that someone made the unrealized gains is because the stock was above the shorter term moving average. But now if we did that in reverse, how does someone lose those gains, unrealized gains, or even lose capital? The stock is below the shorter term moving average. Right? Is that sinking in? Okay. So if the investor says, James, this trend 5 is telling us we're below the short-term moving average, we're losing momentum. Now the investor got to ask themselves the question, do you want to sell or do you want to protect? The investor has 100 shares of stock. They might say, I'm not going to sell, I'm going to protect. And that protection, listen, is not indefinite. The protection is only to expiration. Now the golden question is, but when would you exercise that right to sell the shares at the strike price? Pretty simple answer, okay? Or an answer might be, well, if the strike price that you bought is higher than the stock price, you might say, I want to exercise my right to sell the shares at the strike price that you bought, because that's higher than maybe where the stock price is, okay? Now, does that mean the investor has to sell the shares? No, if they say, James, I'm going to take the profits on the protection and hold the stock and theoretically reduce the average price of what they own the stock for, that's an option. But for our simplicity, we're just going to say, look, if the stock is set to close below the long put strike price, we're going to exercise that long put, which means you have a put. You exercise your right to sell the shares at the strike price. If you have 100 shares and you sell 100 shares, how many shares do you have now? 0. Okay. So if that stock within 4 to 10 days is set to close below the long put strike price, we're going to show the example of exiting the long put and closing out the entire position. Okay, now Luke says, I need to protect more than selling. Oh my gosh, what an observation. Now I'm going to tell you, this is what happens, okay? Let's say the investor has 15 positions. The market is going up. I'm a genius. The market then starts going down, and they get stomped out, stomped out, stomped out, stomped out, stomped out. And by the way, on the way down, they probably get stomped out of a lot initially. And on the way down, if they had 15 positions before, how many positions do you really think they have when the market is done pulling back? James, I now have, like, example given, 3 positions. Okay? So when you have 3 positions and the market has been pulling back, and you just got stomped out of a whole bunch of positions, and the market starts to go back to the upside, and you're starting to see crossovers, you see breakouts, you see trend number 2, does the investor just say, yeah, I'm going to get back in? Psychology-wise, no, they ain't going to get back in. They're being a turtle. They're putting their head in the shell and saying, are you nuts? I'm not going to get back in. I just got stomped out of 12 out of 15 positions. Now I'm sitting in cash, and I'm scared. Am I talking to anyone here? Right? So what's the advantage of collars? Well, if you, for example, if you had maybe a mixture of stops and collars, let's say you get stomped out of not 12, but maybe 6 out of 15 positions. And when the market pulls back, instead of having 3 positions, you have 9 positions. Who do you think is more likely to buy the breakout or the moving average crossover? The person that got stomped out of 80% of their portfolio, the person that still has a large chunk of their portfolio. Oh man, if we were to guess which investor or trader is likely going to buy the breakout and or moving average crossover, we probably say the person that did protection. Okay, the person that still has hypothetically a larger amount of positions than the person that got stomped out of a lot of positions. Okay, now I'm telling you, we've seen this. Okay, this is not like the first time we've seen it. So the reason why we sprinkle some collars in the portfolio or protected puts, it's that way when we see the market go back to the upside, our confidence is not shaken. Because yes, we lost some positions. There's going to be some exits, but we still have some positions. And the core of the portfolio could still be intact. They're down, but we still have some positions and capital is invested. This is a major point, okay? So you're only allowed 1 good question a session. But that comment was a very good comment, okay? Now, yeah, okay, good. Now, what I want to do is kind of show just briefly in closing, okay? So I wanted to kind of tell you, if someone is teaching you about investing or trading and they do not include psychology, okay, that's kind of misleading, I think, okay, because it is also the person that's reading the technical analysis and the fundamentals, and talking about that psychology is important. So I want us to keep an eye on XEL. We talked about the utilities yesterday, okay, keep an eye on that. Also want us to keep an eye on NVIDIA. It hasn't broken down below the 134. Keep an eye on that one. 2 soft down days so far, not massive. Microsoft, another one that's holding in there quite well going into the earnings. Keep an eye on that. And also, when we also look at, let's say, other examples, I want us to keep an eye on maybe if we looked at McDonald's, they had, well, the CDC said there was a link to E. coli. I like to kind of see the reaction. Is there a company statement confirming that? It did gap down. Sometimes you get news, okay, and maybe the news is not as bad as expected. I want us to keep an eye on Mickey D's, which had the drop down. Earnings upcoming. Like to see more information on that. So let's keep an eye on that as well. Now, I'm out of my time here today, okay? So we did a couple trades here today. We talked about protection, okay, using collars. We talk about how that protection also plays into psychology, okay? And also kind of plays into the willingness of the investor to trade what they see based on the recent pullback and how they played that pullback with using options as protection on their stocks. Now, remember, I want to thank Brent Morris for answering those questions in chat. We have short verticals coming up next. I want to thanks to all of you for having a discussion. I think sometimes it's good to have these discussions where we kind of say, hey, what have you seen? And talk about that. And how might the investor involve in their trading life through their own experiences of some things that they might consider. Now, remember with what we discussed, it was done for example, illustrative purposes only. Remember, trading trends are not just uptrends. Sometimes that trend is neutral and sideways and pulling back. And that's kind of really what we've been talking about this last week is how do we kind of handle these pullbacks, okay? And so it's been a great discussion with you here today. Stay tuned for our next webcast coming up at the top of the hour. Subscribe if you have not done so already. And I'll be back on tomorrow morning with Kevin Horner as we talk about ETFs. Thank you so much. Take care and stay tuned for our next session coming up next. Bye-bye.